There's a pattern in history that has destroyed three global superpowers in the last 500 years. And right now, in 2025, the United States is following that exact same pattern, stage by stage, decision by decision, almost like we're reading from the same script that led to catastrophe every single time before. In 1590, Spain was the richest empire on earth. They controlled half the world's gold and silver. Their military dominated Europe. Their currency was accepted everywhere. Within 80 years, they were bankrupt, a second-rate power that never recovered. In 1914, Britain ruled the largest empire in human history. The sun never set on British territory. The pound sterling was the global reserve currency. Within 40 years, the empire was gone. The currency collapsed. There is a sequence that repeats in the life of great powers. It does not begin with invasion or revolution. It begins with arithmetic. First comes advantage, a new financial architecture, a surge in productivity, a currency the world begins to trust. Trade routes expand, credit deepens. Military reach grows quietly in the background, prosperity compounds. Then something shifts. Success breeds obligation. Obligation breeds leverage. Leverage breeds fragility. The empire does not notice at first. Growth continues, markets rise. The capital city becomes the center of global finance. Foreign nations hold its debt. Its currency settles trade across continents. Its bonds are treated as safe. Its military guarantees sea lanes, alliances, stability. But beneath the surface, the ratios begin to change. Debt rises faster than output. Military commitments expand faster than revenues. Domestic consumption grows faster than production. The currency strengthens not because of industrial dominance, but because there is no immediate alternative. Confidence becomes the foundation. History records this sequence with unsettling consistency. 16th century Spain followed it after silver from the New World flooded into Europe. 19th century Britain followed it at the height of industrial supremacy. The Soviet Union followed it under a different ideology, but the same mathematics. Each believed its structure was unique. Each insisted its moment was permanent. Each reached the same late stage, rising obligations, slowing productivity, increasing financial engineering, and the quiet substitution of debt for growth. There are 7 stages in this pattern. The first is emergence through structural advantage. The second is consolidation of financial and military dominance. The third is global integration, where the currency becomes central to trade. The fourth is peak leverage, when debt expands under the assumption of permanent stability. The fifth is erosion, masked by strength. The sixth is loss of confidence. The seventh is reset. Spain reached stage 5 when silver shipments could no longer cover imperial commitments. Britain reached stage 5 when global obligations outpaced industrial competitiveness. The Soviet Union reached stage 5 when military expenditure consumed economic oxygen. The United States now sits at the same stage, not in collapse, not in chaos, in erosion masked by strength. Bond markets still function. The dollar still clears global trade. Defense spending remains unmatched. Technology firms dominate equity indices, but the underlying ratios have shifted. Federal debt has grown faster than national output for decades. Interest payments are becoming structural expenditures. Manufacturing's share of the economy has declined while financial assets expand. This is not a prediction of imminent crisis. It is recognition of a stage. Stage 5 is the most deceptive phase in the cycle. It feels stable. It looks powerful. The system continues to operate. But the foundation has moved from production to leverage, from surplus to refinancing, from structural growth to asset inflation. And once a nation enters this stage, history suggests that the path forward narrows. The pattern does not care about ideology. It does not respond to speeches. It does not negotiate with optimism. It responds to incentives, to debt ratios, to trade balances, to confidence. The pattern is already in motion. The pattern becomes clearer when stripped of politics and personality. It is an economic mechanism that unfolds in stages, each one building logically on the last, each one narrowing the range of available outcomes. In the early phase, a rising power gains a decisive advantage. Sometimes it is technological, sometimes geographic, sometimes institutional. Spain had access to unprecedented bullion flows. Britain industrialized earlier than its rivals and controlled maritime trade. The United States emerged from the Second World War with intact infrastructure, unrivaled manufacturing capacity, and a currency backed by gold, while others lay in ruins. This advantage is real. It produces genuine growth. Living standards rise, the state gains fiscal capacity, trust builds. The second stage is consolidation. Financial systems mature, capital markets deepen. The state can borrow cheaply because lenders believe in its future productivity. Military reach expands, not as an act of desperation, but as an extension of economic power. Trade routes are protected. Alliances form around stability. The dominant power becomes the system's anchor. In the third stage, the currency moves from national instrument to global infrastructure. It is used to settle trade, price commodities, and store reserves. This creates an extraordinary privilege. The issuing state can borrow in its own currency at scale. Deficits no longer impose immediate penalties. External imbalances are absorbed by foreign demand for safe assets. What once required surplus production can now be financed through confidence. The fourth stage is leverage. Debt grows faster than output, but the system appears healthy because growth continues and borrowing costs remain low. Financial innovation accelerates. Complex instruments distribute risk across institutions and borders. Asset prices rise, reinforcing the perception of wealth. Policymakers interpret this as proof of resilience rather than a shift in structure. Then comes the fifth stage. This is where the danger becomes subtle. Productive capacity slows, not catastrophically, but persistently. Manufacturing erodes relative to consumption. Real wages stagnate even as asset values inflate. The state becomes increasingly reliant on borrowing not for expansion, but for maintenance. Debt is no longer a bridge to future growth. It is a mechanism to sustain the present. Crucially, confidence remains intact. Foreign holders continue to buy bonds. Markets function. The currency stays strong. This masks the deterioration. Leaders interpret stability as validation. Warnings are dismissed as pessimism. Comparisons to history are rejected on the grounds that the system is more sophisticated now. Stages 6 and 7 are driven by psychology rather than spreadsheets. Confidence erodes. Not all at once, incrementally. A failed auction, a sudden repricing of risk, a geopolitical shock that exposes fiscal fragility. Once trust weakens, leverage works in reverse. Financing costs rise, policy options narrow. Choices that were once gradual become abrupt. What makes this pattern so persistent is not ignorance, but incentive. Every participant in the system benefits from postponing adjustment. Politicians avoid austerity, markets favor liquidity, citizens prefer stability to reform. Each decision is rational in isolation. Together, they lock the system into trajectory. This is why collapse, when it comes, feels sudden. Not because it was unpredictable, but because the preceding stage was designed to feel permanent, and it is why understanding stage 5 matters more than predicting stage 7. Spain offers the earliest modern example of this sequence unfolding with mathematical precision. At the beginning of the 16th century, the Spanish crown possessed a structural advantage unmatched in Europe. The union of Castile and Aragon created political consolidation. The voyages of Columbus opened access to the Americas. By the mid-1500s, vast quantities of silver were flowing from mines such as Potosi into Spanish coffers. The influx transformed Spain into the financial center of Europe. Its armies dominated battlefields from Italy to the Low Countries. Its fleets crossed the Atlantic with regularity. Creditors across the continent were willing to lend against the steady arrival of bullion. This was stage 1 and 2 in rapid succession. Advantage, then consolidation. By stage 3, Spain's silver effectively underwrote European trade. The metal moved beyond Iberia, settling debts and financing wars across the continent. Spanish power rested not only on military force, but on its role as a monetary anchor. As long as shipments continued, obligations could be met. Confidence remained high. Then leverage accelerated. The crown borrowed heavily from German and Italian banking houses, pledging future silver deliveries as collateral. Military commitments multiplied. Spain fought in the Netherlands, against the Ottoman Empire, against France, and later against England. Each campaign required financing. Each campaign was justified as necessary to preserve imperial stability. Debt expanded faster than the crown's reliable income. At first, nothing seemed unstable. Silver fleets continued to arrive. The empire's reach remained vast. Madrid was the center of decision-making for a global network stretching from Manila to Mexico City. But beneath this image of strength, the domestic economy weakened. Inflation surged as silver flooded European markets. Local industry struggled against cheaper imports purchased with bullion. Spain began to consume more than it produced, relying on external goods paid for by precious metals rather than by competitive manufacturing. This was stage 5. The empire still functioned. Armies marched, fleets sailed, credit flowed, but structural erosion had begun. Productive capacity at home lagged behind imperial ambition abroad. The state increasingly depended on borrowing against uncertain future shipments. When storms, piracy, or war disrupted silver convoys, fiscal stress intensified. Between 1557 and 1647, the Spanish crown declared multiple sovereign defaults. Each restructuring temporarily restored confidence. Each default also signaled that leverage had exceeded sustainable capacity. The empire did not collapse overnight. It decayed. Military defeats accumulated. Provinces revolted. Trade leadership shifted northward toward the Dutch Republic and later England. Spain's power faded, not because silver disappeared immediately, but because reliance on silver replaced the need to cultivate diversified growth. Debt substituted for productivity. Military commitment substituted for economic reform. Confidence masked fragility until creditors began to demand higher compensation for risk. By the time Stage 6 arrived, adjustment options were limited. The fiscal foundation had already weakened. Inflation had eroded domestic competitiveness. External rivals had strengthened. The pattern did not unfold as drama. It unfolded as accounting. And by the time Spain recognized the shift, the ratios had already turned against it. 2 centuries later, the pattern resurfaced under a different flag. 19th century Britain stood at the center of the global economy. The Industrial Revolution had begun on its soil. Coal-powered factories, steamships connected continents. London became the clearinghouse of global finance. Sterling bills settled trade from India to Argentina. The Royal Navy secured sea lanes, suppressing piracy and protecting merchant fleets. Britain's advantage was structural. It combined technological leadership with maritime dominance and deep capital markets. Investors trusted British law. Foreign governments borrowed in London. Insurance markets matured. Railways stretched across continents financed by British savings. For decades, growth appeared self-reinforcing. This was the ascent through stages 1, 2, and 3. By the late 19th century, sterling functioned as the world's reserve currency. Gold convertibility underpinned credibility. Britain could run trade deficits while exporting capital. Its investors financed infrastructure abroad, earning returns that sustained domestic consumption. The empire's reach was vast, and the financial system sophisticated. Then, subtle changes emerged. Germany and the United States industrialized rapidly. Their manufacturing output expanded faster than Britain's. Steel production, chemical innovation, and industrial scale began shifting across the Atlantic and into continental Europe. Britain retained financial supremacy, but its industrial edge narrowed. Debt rose to sustain global commitments. Military expenditures increased to maintain naval superiority. Colonies required administrative and military oversight. The cost of preserving the empire began to outpace the productivity of the domestic base. Yet the system appeared stable. Sterling remained trusted. The City of London continued to intermediate global capital flows. Britain's deficits were financed because investors believed in imperial permanence. The narrative of exceptionalism was deeply embedded. This time, policymakers believed was different. Financial sophistication would offset industrial decline. This was stage 5. The erosion was gradual. Britain increasingly relied on income from foreign investments rather than competitive manufacturing. Its share of global output declined while its global obligations remained fixed. When the First World War erupted, the fiscal strain became visible. Britain suspended the gold standard. It borrowed heavily, particularly from the United States. After the war, it attempted to restore sterling's pre-war parity, prioritizing financial prestige over economic flexibility. The decision deepened structural weaknesses. An overvalued currency hurt exports. Unemployment persisted. Debt burdens remained high. By the 1930s, sterling's global dominance had fractured. The financial center of gravity shifted decisively toward New York. Britain did not collapse into chaos. It transitioned into a secondary power over decades. But the pattern was unmistakable. Industrial leadership gave way to financial reliance. Financial reliance masked declining competitiveness. Military commitments outlived economic foundations. The late stage felt manageable until external shock accelerated adjustment. The narrative of permanence dissolved quietly, replaced by arithmetic. And the arithmetic did not negotiate. The Soviet Union followed the same trajectory under a different ideology and a closed financial system. Its structural advantage was not maritime trade or precious metals, but centralized mobilization. After the devastation of the Second World War, the Soviet states rebuilt heavy industry at extraordinary speed. Steel output surged, energy production expanded, military technology advanced rapidly. The command system could redirect resources toward priority sectors without market constraints. For a time, this created the appearance of relentless expansion. This was its ascent. By the 1960s and 1970s, the Soviet Union had consolidated influence across Eastern Europe and projected power globally. It maintained vast military forces, nuclear parity with the United States, and ideological alliances stretching from Cuba to Vietnam. Energy exports generated hard currency. The state controlled credit, wages, and investment. There were no bond markets signaling risk, no currency traders repricing exposure. Stability appeared embedded in structure, but the same stages unfolded beneath the surface. Productivity growth slowed. Innovation lagged behind the West, particularly in computing and consumer technology. Central planning struggled to allocate resources efficiently in a complex economy. Military spending consumed a disproportionate share of national output, estimated at levels that strained civilian investment. The state prioritized geopolitical competition over domestic modernization. Oil exports temporarily masked inefficiencies. High energy prices in the 1970s provided revenue that sustained commitments. The system looked durable. Superpower status seemed permanent. This was stage 5. The erosion was not visible in public markets, but it was measurable in stagnation. Consumer goods shortages became chronic. Infrastructure aged. The gap between military capability and civilian living standards widened. Debt to Western lenders increased during the 1980s, particularly as oil prices fell and export revenues declined. Confidence within the system weakened before it collapsed externally. Reform efforts under perestroika exposed structural fragility rather than resolving it. Once expectations shifted, the centralized model could not adapt quickly enough. Political control eroded. Republics sought autonomy. By 1991, the Soviet Union dissolved. Again, the end appeared sudden, but the deterioration had unfolded for years. Overextension, slowing productivity, rising obligations, dependence on volatile revenue streams. Denial of structural weakness. The ideology differed from Spain and Britain. The accounting did not. The pattern repeated because incentives repeated. Leaders favored short-term stability over structural reform. Military parity was preserved even as economic capacity plateaued. The late stage felt survivable because the system still functioned. Until it did not. And the transition, once triggered, moved faster than anyone inside the system had imagined. The stage that precedes acceleration is always the most deceptive. Now the pattern reaches the present. The United States emerged from the Second World War with unmatched structural advantages. Its industrial base was intact. Its share of global output exceeded one-third. The Bretton Woods system positioned the dollar at the center of global finance, convertible into gold and trusted by allies rebuilding from ruin. American manufacturing dominated automobiles, machinery, chemicals, and electronics. Productivity growth was robust. Debt accumulated during the war was reduced steadily as output expanded. This was ascent built on production. Over the following decades, the dollar evolved from a national currency into global infrastructure. Energy contracts were priced in dollars. International trade cleared through American financial institutions. U.S. Treasury securities became the benchmark risk-free asset. Foreign central banks accumulated reserves in dollars to stabilize their own systems. The United States could run persistent deficits without immediate funding stress because global demand for dollar assets absorbed them. Financial markets deepened. Innovation flourished. Technology firms scaled globally. The military extended its reach across alliances spanning Europe, Asia, and the Middle East. For decades, growth and leverage appeared compatible. Then, the ratios began to change. Manufacturing's share of employment declined steadily. Consumption outpaced production. Trade deficits became structural rather than cyclical. Federal debt expanded faster than gross domestic product, accelerating after each recession as stimulus replaced organic growth. Interest payments, once marginal, began consuming a larger portion of federal revenue. Asset markets appreciated strongly, creating wealth effects that masked wage stagnation for much of the population. Yet the system remained stable. Treasury auctions cleared, the dollar retained reserve status, equity markets reached new highs, capital continued flowing into American assets, especially during global uncertainty. The narrative of exceptionalism persisted, supported by technological leadership and deep liquidity. This is stage 5. The United States retains enormous advantages: innovative capacity, demographic resilience relative to peers, abundant energy resources, and the world's most liquid financial markets. But structural imbalances have grown. Fiscal deficits are no longer confined to crises. They are embedded in baseline budgets, debt issuance funds, not only emergencies but ongoing commitments. Entitlement obligations rise with demographics. Military expenditures remain expansive amid multipolar competition. Confidence still anchors the system. The dollar's role ensures demand for U.S. liabilities, but the foundation has shifted gradually from production-driven surplus to debt-financed continuity. As long as trust persists, adjustment can be deferred. History suggests that this stage can endure for years. It can even feel prosperous. Markets reward liquidity. Innovation attracts capital. Consumption remains strong. But the arithmetic is cumulative, and cumulative arithmetic narrows options over time. Late-stage systems rarely announce their fragility. They often appear most sophisticated just before adjustment accelerates. In stage 5, policy tools are still effective. Central banks can stabilize markets through liquidity. Governments can issue debt without immediate revolt from creditors. Asset prices respond positively to intervention. Each successful stabilization reinforces the belief that volatility can always be managed. This is the acceleration phase forming quietly beneath the surface. As debt rises relative to output, sensitivity to interest rates increases. A small increase in borrowing costs translates into large increases in interest payments. Fiscal flexibility narrows. Choices that once felt discretionary become constrained. The state must allocate more revenue to servicing past commitments, leaving less for investment. At the same time, markets become conditioned to support. Investors assume that downturns will trigger stimulus. Risk-taking becomes normalized. Leverage embeds itself across institutions. Pension funds rely on high asset valuations. Households depend on rising property and equity prices. Corporations refinance routinely, extending maturities but increasing total obligations. The system appears diversified and hedged. In reality, it is unified by confidence. Acceleration does not require panic. It can begin with something mundane, persistent inflation that erodes purchasing power, forcing tighter monetary policy, geopolitical friction that fragments trade flows, demographic shifts that increase entitlement spending while shrinking the tax base. Each factor alone is manageable. Combined, they compress margins. When financing costs rise faster than growth, leverage reverses its effect. Refinancing becomes more expensive. Fiscal projections deteriorate. Investors begin demanding higher compensation for duration risk. Currency strength, once a shield, can become a constraint by pressuring exports and manufacturing competitiveness. None of this unfolds in a single dramatic week. It accumulates. Adjustments that were postponed in earlier stages become unavoidable. The political system, accustomed to deferral, struggles to adapt to arithmetic limits. Acceleration feels sudden only because the prior stability was prolonged. Spain experienced it when silver shipments faltered amid mounting debts. Britain experienced it when war financing shattered the illusion of limitless sterling credibility. The Soviet Union experienced it when falling oil revenues exposed structural stagnation. In each case, the late stage looked sustainable until the margin disappeared, and margins are always thinner than they appear. Cycles of power are not driven by fate. They are driven by incentives that reward expansion in the short term and defer adjustment into the future. A dominant nation gains advantage through productivity and institutional credibility. It becomes indispensable to global trade. Its currency becomes a reserve. Capital flows inward. Borrowing becomes inexpensive. These are achievements, not accidents. They reflect genuine strength. But strength alters behavior. When financing is abundant, difficult reforms are postponed. When debt is easily absorbed, commitments multiply. When a currency is demanded globally, deficits feel less urgent. Each decision is rational within its context. Leaders prioritize stability, markets reward liquidity, citizens expect continuity. Over time, the structure changes quietly. Production gives way to financial intermediation. Surpluses give way to deficits. Debt replaces savings. The system continues to function, but it rests increasingly on confidence rather than output. No empire collapses because it fails to understand arithmetic. It declines because responding to arithmetic requires sacrifice. Raising taxes, cutting spending, reducing external commitments, restructuring entitlements. These choices impose immediate costs for long-term stability. Political systems resist them. Markets prefer gradualism. Voters prefer comfort. History shows that adjustment eventually occurs anyway. Sometimes it is orderly, a managed decline, a transition to a different equilibrium. Sometimes it is abrupt, a repricing of currency, a funding crisis, a restructuring of obligations. The specific trigger varies. The underlying cause does not. The United States remains powerful. Its innovation ecosystem is unmatched. Its universities, capital markets, and energy resources provide resilience. But Stage 5 is not about visible weakness. It is about structural drift. The narrowing path forward is defined by incentives. Reform requires confronting ratios before confidence shifts. Delay increases leverage. Increased leverage reduces flexibility. Reduced flexibility magnifies external shocks. The pattern does not predict catastrophe on a timetable. It outlines trajectory. Spain, Britain, and the Soviet Union believed their systems were unique. Each was. Yet each followed the same progression from advantage to leverage to erosion. Not because of culture or ideology, but because debt compounds and growth slows. We are living inside that progression now. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle. The answers aren't hiding in the future. They're written in the past, and I'll show you where to look.